Hello and welcome to the May update for the Hedge Invest Benbridge Emerging Markets Absolute Return Fund. May turned out to be a very volatile month, with markets having a big sell-off and then a big rally into the end of the month to close the month almost unchanged. Emerging markets were up less than 1% for the month, and that was mainly due to a weaker US dollar. In local currency terms, emerging markets were slightly negative for the month. The rally started in the middle of May when sentiment achieved all-time bearish levels. We saw significant liquidation in the first half of May from long-only and retail investors. And once the selling had been done and slight change in news flow, we saw a major rally as people chased to get back into positions. Emerging markets had a range of 8% for the month. So at one point, they were down over 8% and ended the month unchanged. What were the main drivers of this rally? Well, we saw a few different macro drivers of the rally come through. Firstly was the talk of easing of policy in China. So China has been running quite a tight monetary policy for quite a while. There's a significant slowdown going on domestically, which we've talked about in previous videos. And we've started to see in earnest a significant easing of policy, a lot of communication from the senior levels of the Communist Party about maintaining the growth trajectory of the markets and the economy. And we also saw earnings for the big tech stocks, so Meituan, JD, etc., all came in line or slightly ahead of consensus. Now, given the derating that has happened in China this year and the valuations that we have, it's not surprising that a small change in sentiment and a small change in the earnings outlook can lead to quite a significant re-rating of stocks upwards. And that's sort of what we saw at the end of May. So we saw valuations at the lows get down to 1.2 times book for Chinese stocks. We saw dividend yields in the region of 5% and PE ratios in the high single digits, so 7, 8, 9% PE ratios. All of these are trough value levels, and the missing component was the positive news stories to then re-rate this market back upwards. And that's what we saw through the middle of the month. The other major macro news and surprises that led to the bounce were in the US, where inflation, while sticky, appears to have peaked, or a lot of people are talking about it having been peaked. Employment is stable, but not as out of control in terms of open job opportunities, etc., as it was before. And the Fed has taken a more nuanced approach and are talking about where they see the rates going, and people are betting that the Fed will stop sooner than they're saying. Now, we think that QT is about to kick off in the US, and that this has a huge unknown quotient involved in it. No one really knows what happens when the Fed does QT, least of all the Fed. And so we're in for quite a volatile period ahead as we engage in the QT process. The one fly in the ointment, the one thing that continues to concern us and keeps us on the sidelines or waiting for the right opportunities is the oil price and energy complex. Oil has continued to rise over the last few weeks as China comes out of COVID lockdowns and people start to see a more normalized path of Chinese growth. And there's now a lot of talk about oil pushing on to new highs through the summer as you get driving season. And so we see that that being a pretty major risk to the inflation outlook and to the global economy. And so we continue to position ourselves bullish on oil and oil services and cautious on the rest of the investment space. If you want to know more detail about what we're invested in and how we're thinking about risk and investing in this volatile environment, please feel free to reach out to your Hedge Invest contact and we can set up a call. Thanks.